Today we're talking about Chapter 4. We're talking about merchandising operations. Remember, the first few chapters we talked about, it was all about service companies. Okay, remember today's lesson, today's chapter, we're switching gears. Talk about merchandising companies. Remember, the companies we buy products from. Think about all the products you might buy from a company. These will all be what we talk about today. Again, what's a merchandise activity? They don't have the income components. Service companies be a little bit different. They sell you time. Accounting firms, law firms, plumbing services. They all sell you their time. Again, they're pretty straightforward. They sell you their time. They earn a revenue from you. Subtract their expenses, get their net income. Okay, very straightforward. Merchandising be a little bit different. Merchandiser, they report income from merchandising. You get a manufacturer. They make the products. Apple, Samsung. They sell it to a wholesaler. A wholesaler is going to be your BJ's, your Sam's Club, your Costco's. Yes, we can go there as members, except it's geared to sell to businesses. And, of course, the retailer. That's the most popular one. The Walmarts, the Amazons, the Targets, the Krogers. And both of these, they want to sell to you and I, consumers. Again, the difference is between the service company and merchandiser. Merchandiser sells products to earn revenue. Sporting goods, clothing, auto parts store. Be a little bit different now. You get your obviously sales, those are the revenues, minus cost of goods sold. Like the name says. How much does that merchandise cost? Remember, they're not going to buy something for $1,000 and sell it for $1,000. They might buy something for $1,000, sell it for $3,000. That's what it means by net sales minus cost of goods sold. Again, the first one, your gross. What was your gross profit? Take out your expenses. And then finally, we get to our net income, our profit. Okay, identify, explain, inventory assets. Now, merchandiser, their main asset, the biggest asset is going to be inventory. Remember, begin to purchase some merchandise. They got to buy what is the merchandise they want. A lot of times, sometimes they have to sell on credit. They got to waste some time. They have receivable. Then they get cash collection. Look at different inventory systems here. Remember, the big challenge, retailers have, they got to keep track of inventory systems. Perpetual inventory system, that updates automatically as merchandise is bought and sold. A periodic system says, nope, we're going to count inventory once a day, once a week, sometimes even once a month. Okay, the key thing is, whenever the end of that counting period, they choose to count inventory. Again, look at different ones here. Again, first we got your cost of goods available for sale. Then you want your cost of goods sold to get your expense. Follow the formula. And you come to gross profit. Take your net sales minus cost of goods sold. Get your gross profit. Here's the last part. You want to get your net income. The big question is how you record the transaction. Remember, inventory is an asset. It's a current asset. So you want to debit it when we first buy because we're increasing it. We paid cash for that inventory. So again, you want to increase one asset, your inventory. It's going up with the debit. And then you want to decrease your cash because, well, we use cash to pay for it. So, of course, cash is going down. One asset's going up, inventory. Except then you got to credit cash because we use cash to pay for it. In credit terms, a lot of times when you buy inventory, you have credit terms, the terms of the deal. So, all right, we made a deal, you bought some inventory. Well, what are the terms there? Okay, sometimes, to pay quicker, they might offer you a discount. Here it tells me, if you pay the invoice within 10 days, we'll give you a 2% discount. Remember, you don't have to use the discount. If you don't pay in 10 days, you have to pay the entire amount, full amount, in 30 days from the invoice date. So here it says, again, you bought some inventory on account. So, of course, we're going to increase inventory with the debit. And you want to increase your liability accounts payable because you bought on credit with a credit. Again, review your invoice. Remember, invoice is a fancy word for bill. So, okay, let me review my bill. What did I buy? How much? What did it cost me? Who do I owe money to? What's the due date? Now I paid them. Now remember, the accounts payable, you want debit to decrease it. It's off my books now. I pay that $500, I'm done. Now, it's very important here. I didn't pay $500 because I got a 2% discount. I only had to pay 98%. That's why I want to credit cash. Cash went down $490. Then you want to credit inventory for $10 because you want inventory to be reflected at the price you bought at. Even though you have $500 of inventory, it's worth $490. Now when you decrease inventory by $10, now it evens out. Again, how it look on the T account. That's what I talked about earlier. See inventory now, it's listed at the amount you paid for it, even though it's worth $500. Remember, accounting says you always want to record items at their cost, not their value. Again, if you don't, like I said, you don't have to use a discount if you didn't. You just pay the full amount. Debit accounts payable decrease $500. Credit cash, you decrease that by $500 because you use cash to pay for it. Now, what happens if someone gives a return or an allowance? A return means there's nothing wrong with the item. You returned it, said, okay, thank you. For whatever reason, you don't want it. You're going to sell it again. An allowance means, nope. Say, sorry, you might return it, but in the meantime, you can't sell it again. It's defective. It's gone bad. So, nope. Sometimes you don't even tell a consumer, listen, you keep it, throw it away. I'll just, reduce how much you owe me. I'll give you a credit. So again, how does it work here? Well, again, you want to decrease payable because you're not going to pay that anymore. Because again, so nope, sorry. Okay, so listen, don't worry about it. Just throw it away. We'll decrease how much you owe us by $30. And of course, you reduce your inventory by $30 because it's no longer in your inventory. You threw it out. Now, how to look all together here? You bought some inventory, $250. You returned some of it, so decrease your payable. Then when you paid for it, remember now, you bought $250, returned $50, you only owe $200. And you get a $4 discount there. Now, the question comes, transportation costs. Who pays for them when you get ownership? Remember, if it's the FOB shipping point, the buyer pays for them. And again, the minute they're shipped, they're your goods, even though you haven't received it yet. And how do you record transportation? You would debit inventory, credit cash, because inventory reflects everything you pay for that inventory. If you had to pay for taxes, insurance, shipping charges, all that goes to inventory. If it's destination, the seller pays for it. And you don't get ownership of the goods until they come to you. For the seller, that's the routine delivery expense, and then credit cash. And transportation costs we talked about, it was all the costs of my inventory. So you debit inventory to increase it, credit cash to decrease it. Again, give an example here, the goods cost $235,800, but again, take out some discounts, some allowances, add some transportation. This would be the final cost that'll be on your financial statements. Again, some examples of some. About $1,000 of goods. Again, just debit inventory, credit payable. Paid for the freight charges. That's routine. Like I said, that's inventory. Credit cash. Return $50. Credit debit payable, decrease it, and credit inventory because it's no longer in your inventory warehouse. The last part, pay the amount that you owed. Again, assuming it was never made, instead of payment, again, less the return. Again, the only difference is now you just pay the full amount in cash. Yeah, now we do if we bought inventory. Now how about if we sold inventory? Doing their perspective. Okay, so it's always net sales minus cost of goods sold to get the gross profit. Every time you sell merchandise, you always make two transactions. One to record the revenue, one to record the cost. Now it says here sales without cash discounts. Again, the revenue side, sold an account, debit receivable, credit sales to increase it. Then the cost side, you always want debit cost of goods sold. How much it cost you to increase your expense? You want to credit inventory to decrease your inventory because inventory is going down. You sold that. Again, sales discount now. Now you're not receiving sales discounts, you're giving sales discounts. Again here, for the sale. Now again here, they pay in the discount period. Keep track of that. So they have a coupon to use. So sales discounts. You debit that. Credit entire amount $1,000. Even though you owed $1,000, you only got $980 to increase that with a debit because, well, that's how much cash you received. It pays after discount period. Again, after discount, again, there's just no discount there. The debit sales and credit receivable. Now let's do sales returns and allowance. Now if you got a return back. Remember, this is going to be standard one. It's sold $15. So you want debit sales returns and allowances, $15, and you gave them cash back. Now if it's not defective, it's going right back on your shelf. So you want debit inventory, $9. to increase your inventory, then you credit cost of goods sold to remove the cost of goods sold there. The return goods are defective. Well, now you can't put them back on the shelf, right? Again here, you lost some of the defective inventory. Now, if it's a sales allowance, you only have to do the first entry because it's not going back on the shelf. Yeah, some example sums. So 50 units. Again, we talk about it. You want to increase receivables and sales. One with the debit, one with the credit. You want to do the cost side. You accept the return back. Nothing wrong with them. You put them right back to inventory. That's 2 entries there. Again, the last part. Let me get paid cash for that. Remember, we got a discount though. How can income statement? Again, still start with the revenue, sales. Take out sales returns and allowances. Sales discounts to get to your net sales. Minus cost of goods sold to get to your gross profit or gross margin on sales. Yeah, just in entries, closing entries. So we start here. Remember, shrinkage for whatever reason. Lost merchandise. Things got stolen. They broke. They got damaged. Obsolete. You do your inventory count. You find a difference there. Now to adjust it, you want to debit the difference to cost of goods sold to increase the expense. And credit inventory, decrease it, so now it accurately reflects how much inventory you really have. And remember, sales discount, sales returns allowances, and cost of goods sold is all temporary accounts. They also get closed out. Again, start with this part. Again, to do our closing entries. First of all, this one says to close the balance, update the revenue, update the cost of goods sold. Like I did earlier for shrinkage. Time to close them out. We did earlier, last chapter. Debit sales to decrease it goes to income summary. Sales discounts, returns, cost of goods sold. Then our expenses, depreciation, salaries, other operating expenses. That all goes to income summary. Okay, and again, remember these are all temporary accounts. So they're all being closed out. And the difference, which is your net income, that goes to income summary, credit retained earnings. Same with dividends. Again, prepare multiple income statement. Remember, the only difference is, the retailer got more steps now. We start with our sales, discounts, your gross profit, your operating expenses. Break them up. What are your selling expenses? Your general and admin. Income from operations. Do you have any other revenues and gains or expenses and losses? Single step says, nope, let's put all the revenues together, all expenses, that's it. So if you notice, to give you the same net income, the only difference is one has more steps and more details. Classified balance sheet, inventory we talked about earlier, it's a current asset. Let's tear it here. Again, same thing we talked about earlier. Get our gross profit, get our expenses, classify your expenses, get your net income. All right, class. Let me know if any other questions, all right? Thank you.